All right, so like I said, I'm in exam 3, and I'm going to start with problem 1 and part 2. So it's a budgeting question, and it says, Fine Furniture Company manufactures wooden tables. Management is preparing the budgets for June and has accumulated the following information. And then it gives us a bunch of information, and it wants us to prepare the sales budget of tables for the month of June. So I'm going to type in here so that it's neat. Sales budget. Okay, so the sales budget is real simple. The sales budget, we just want to know the expected sales, selling price per unit, and then total revenue. And there's only one thing that we're making here, the tables. So in the question, the information that it gives us, it tells us that the expected June sales are 2,000, and it also tells us that the selling price per unit is 250 per table. So we can just put that information in. Not there though, there we go. 2,000 in expected sales, it's 250 per unit. And if we multiply that together, we get 500,000 in revenue. That's all it wants for that question. But if we move on, Fine Furniture does not have a work in process inventory since all units are completed on the same day. Ending finished goods inventory is maintained at 5% expected sales for the next period. Prepare the production budget, the total units of tables for the month of June. So this is a units budget. It's the production budget. So the production budget, we want to know expected sales currently. We're going to want to know what the beginning inventory is. We're going to want to know what the expected sales for the next period are. We're going to want to know the ending inventory, and we're going to need to know how much goes into production. And I need all that on one line. Okay, so all that information, well, most of that information is also given to us. So the expected sales currently up here is the 2,000 from before, and the expected sales in July, it tells us is 2,500. And it tells us in the problem that the ending finished goods inventory is maintained at 5% of expected sales for the next period. So that is also important information. Of course it's doing that. Sorry, okay. So the expected sales for June were 2,000. And then if we multiply that by 0.05, because it's 5%, we'll get that we should have rather a beginning inventory of 100. We have an ending inventory, which is going to be the beginning inventory of the next. So the beginning inventory that we start with is 5% of what they expected to sell in June. So that's where the 100 comes from. And then for July, it was 2,500.
I have a quick question. Where did you get the 100 from?
So, right. So if we multiply 2,000 times 0.05, we get 100. It says here that the ending finished goods inventory is maintained at 5% of expected sales for the next period. So at the end of when they did their production in May, they said, okay, we're going to need to have 5% of what we expect to sell in June already there. They need something to start with. So 5% of what they're expecting to sell in June is 5% of 2,000, which is where the 100 comes from. And that's kind of what they want to start with. Does that make sense?
Yeah, I guess like I was just confused, like why wouldn't you multiply like the 2,500 times the 5% and why we're doing it to the 2,000?
Oh,
If
well,
it's
we're
like
going
for
to do
sale for
that.
next week.
Okay, right. So let me, here, we're going to pull out my best friend. So we have there's no WIP, right? But there is a finished goods. There is of course, nothing is working. There is a finished goods inventory, right? So they are expecting to sell, why does nothing work? They're expecting to sell 2,000 tables in June. And they want to, there has to be some, according to the way that they do this, we had to start with something. There has to be a beginning inventory somewhere. So that's why we do the 2,000. We're expecting to start June with 5% of what we expect to sell. So that should be a 0. And then over here for the ending inventory, we're going to do 5% of the 2,500 because that's how much we want our ending inventory to be at the end of the month. So if I head back to my table over here, if we multiply the 2,500 times the 0.05, we'll get an ending inventory of, what is it, 125. So that means that our ending inventory for our little T account has to be 125. And now what we're looking for, that production number at the end, that's this number here. We had to start with 100. We had to start with some sort of beginning inventory amount because they like to maintain a certain amount of inventory. So we started with 100. We know we're going to sell 2,000, or we hope we're going to sell 2,000. And we need to have something started, something for the beginning of next month so that we don't get behind. So we want to have an ending inventory because in July, we're expecting to sell 500 more tables than we sell in June. So we'll have an extra, of a little bit extra left over. So that's 125 tables left in finished goods. So we need to know how many do we need to make. If we start with 100, we're going to sell 2,000 and we want to have 125 left. How many do we need to make? That's this production number here. And if we do the T account, if we do the A plus B minus C equals D, if we do the math, so 2,000 plus 125 minus 100, we get that the production amount is 2,025. Does that make sense?
Yeah, could you just write out the math? Just so I'm
Yes,
following.
absolutely. So if we do A, so if we call this, if we call the, if we call the 100 A and we call this number B and we call this C and we call this D, we know that A plus B minus C equals D. That's just the way that the accounts work. And so we're looking for B. So that's going to be equal to B plus C minus A. So it's going to be 125 plus 2,000 minus 100 equals 2,025. Okay?
Yeah, thanks.
Perfect. All right, so now we're going to do this last one. So Fine Furniture is located near a lumber supply store and only purchases material as they are needed in production. They do not carry a materials inventory. The company has an agreement to pay their suppliers 60% of the cost of purchases in the period bought and the remainder in the following period. The accounts payable balance at the beginning of June is $30,000. What is the amount budgeted to be paid in June for direct materials? So now we're looking at like a direct materials, like a money budget. The one before was a units budget. This is cash now. So we need to know the budgeted production, which we just figured out. We need the direct materials per unit. We need the cost. Cost per foot. And we're going to need to know the total product required. So this information is also up top. If we go up and look, we can see that it also tells us that we need 40 feet of material per unit, and it costs 50 cents a foot. Oops. So we go to fill in our little chart. We also just decided in the last answer that we need this 2025. That's how much we need to make. So we are making 2,025 tables, and they require 40 feet per unit, and they cost 50 cents per foot. If we just multiply all that straight across, then we get 40,500. That's how much we're spending for materials. But that's not how much we're paying, right? We are paying 60% from this period and the 40% left over from last period. So the amount that we paid this period is going to equal 40,500 times 0.6, because it's 60% of that. So that is 24,300. And then the amount we have to pay from last period, they told us in the question, was 30,000. That was, oh no, it's down here. That's right there. So this will just, I'm just gonna write that given so that it lines up nicely. So then the amount that we have to pay is just, hit the tab, 54,300. Just add those two things up, and that's what we have to pay for this period. And that's all this question is asking for. Are there any questions about any of this? Good?
All good.
Awesome. All right. Problem 2 is about standard costs and variances, and these aren't too bad, but there are two ways of doing it. There was the way that I learned how to do it, and then there was the way I learned how to do it this year because that's how your book did it. And so I can show you both ways to do it. I guess it just depends on which way you like better. But it says Fowler Company manufactures titanium molds and uses standard costing to account for their production line results. And then it gives us a bunch of information. So the first question it asks is, what is the amount of direct materials price variance? Is it favorable or unfavorable? So for a price variance, what we want to do is compare the price of what we actually paid to what we should have paid. The standard price is what we should have paid. So in order to do that, we're going to have to, we need some sort of quantity. So we're going to take the actual quantity and hold that constant. We're going to multiply everything by the actual quantity. And we're going to take the actual price and compare that to the standard price. You've probably seen, hopefully you've seen this equation. So in the question, it tells us that the actual quantity purchased, so for a materials price variance, we want the actual amount purchased, not the amount used. We want to know if the purchasing manager is doing a good job. So we have to use the amount that's actually purchased. So there were 50,000 kilograms purchased, and he paid 315,000 for that. So to find the difference here, we've got 50,000 kilograms for $315,000, and we also know that they should be $6 per kilogram. So $6 and $315,000 are not really something that we can compare just yet. So we're going to take our 315,000, we're going to divide it by the 50,000, and we're going to get that answer is 6.3. And that's what we're going to compare to the 6. So we will say 50,000, multiply that by the actual price of 6.3, less the standard price of 6. And if we just do the math, we're going to get a positive 15,000. And positive numbers, if you do the math this way, the positive numbers mean that it's an unfavorable difference. Because a positive number tells you that the actual price that you paid is more than the standard price that you paid. You paid more than you should have, and that's bad. That's unfavorable. So that's the direct materials price variance. But the direct materials efficiency variance, let's go back to blue. The efficiency variance, now we're going to take the standard price, because we're going to try to compare the quantities now. So we need to just hold the price constant, but that's not changing, and we're going to compare the actual quantity to the standard quantity. And it tells us what all those things are. It tells us that we used 51,000 kilograms in production, and that we're supposed to use 5 kilograms. And it also tells us that we produced 11,000 units. The sales number of 12,000 units, we don't care about that. That's just distractor information. So, also the 5 and the 51,000, those are numbers that we can't really compare very well. So if we multiply the 11,000 units that we made times the 5 that it should be, we get that the standard quantity here is 55,000. So we can put all of that into our equation, and we can say,
where are you getting the 5 from to multiply by the actual production?
right up here. Right here, this 5 right here.
So when you're doing the 11,000 units times the 5 units, what are you finding out?
So that's how many, so we're just going to call it 11,000 units. So if everything goes exactly according to budget, you should need 55,000 units in order to create 55,000 units of direct materials in order to create 11,000 units. They're saying in the facts, they're telling us that they used 51,000 kilograms of whatever it is to create 11,000 units, but the standard budget is telling us that they should have needed 55,000 units.
Okay.
So if we just put all this into our handy dandy little equation, so the standard price was also up here. That was the $6 per kilogram that we used before. The $6 per kilogram and 5 kilograms per unit. So the standard price is 6, and then the actual quantity was 51,000 units, and the standard quantity was 55,000 units. So if you just do the math for that, you'll get a negative 24,000. Negative numbers, if you use the equation this way, a negative number tells you that it's a favorable difference. The amount that you actually used is less than the amount that you were supposed to use. And so that's good, right? We want to, not be wasteful. So this is a favorable difference. Make sense? All right, so now we're going to do the direct labor rate variance. So this is a very similar to what we just did. So the rate variance, again, we're going to take a quantity and hold it constant so that it's not moving, and then we're going to compare the actual price to the standard price, because we're trying to see how the labor rates differ. So let's go up and look at what they're telling us in the facts. It tells us that the actual amount of hours used was 65,000 hours. And it tells us that we spent $800,000 for that. And it also tells us that we should be spending $12 an hour. So $800,000 and $12 are not really something that we can compare very well. So we're just going to get those down to something that we can compare. So if we take the 800,000 and divide it by the 65,000, we'll get 12.31. So now we can take that actual quantity of 65,000 and compare it to the actual.
12.31 is what you're paying them for each hour?
Yes.
Okay.
That's what we actually paid them. We were only supposed to pay them $12 an hour though. So if we actually paid them $12.31 and we were supposed to only pay them $12, what do you think this result is going to be here? Favorable or unfavorable?
Unfavorable.
Right. We're going to end up with $20,000 unfavorable because we paid them more than we had budgeted for. So the last one, the direct labor efficiency variance. So the efficiency variance is how well their labor was used, right? So we know that there were 65,000 hours and they were supposed to take 6 hours per unit. And we know that there are 11,000 units that were produced. So if we multiply the 11,000 units that were produced by, it's supposed to take 6 hours per unit. So 11,000 times 6 is 66,000. So the rate or the efficiency variance down here is same as the efficiency variance up top. So efficiency variance, we take a standard price and we hold it constant so that we compare the quantities of hours that were required. So the actual quantity and compare it to the standard quantity. So the standard price from up above is 12. And then the actual quantity used was 65,000 hours right here. I don't know where my 66 went, but that's what the standard quantity is. So the 12 times the 65 minus the 66 is going to give you negative 12,000. And since it's negative, that's a favorable difference, right? We actually used 1,000 hours less than we were supposed to. And that's where that went.
So you're getting this when you multiply the 11,000 times 6, that's because it was 6 hours per unit and the actual production would be 11,000.
So, right, we actually produced 11,000 units. So regardless of how many units you make, it should only take 6 hours per unit. So we made 11,000 units. It should take 6 hours per unit. So it should take 66,000 hours. But in reality, up here, it says it only took 65,000 hours. So we're trying to figure out, like, is that a good thing or is that a bad thing? And so that's why we do the variance this way. So there's this way to do the variance, and then there's also the way that they were doing it in the book. So you remember there was the split costs, and the split cost was the standard price times the actual quantity. And then there was the whole thing with there was the actual, and there was the split, and then there was the standard. And the difference between the actual and the split was the price variance, and the difference between the split and the standard was the efficiency variance. So we can do that instead. You don't have to do it both ways for sure, but you could do it this way instead, and it's just a different way of getting to the same answer. So pick a different color here. To do it this way, you would need to know that the actual cost was 315,000. So we're going back to the direct materials. The actual cost was this 315,000 for direct materials. That's how much we purchased. And the split cost is the standard price times the actual quantity. So the standard price is $6 per kilogram, and the actual quantity purchased, not the quantity used, the actual quantity purchased is 50,000. So that's 6 times 50,000. So that's gonna be 300,000. So then you can just take the actual minus the split, and you get a difference of $15,000. And it's still positive, and it's still an unfavorable difference. Just a different way of getting to the same answer. And we can do the same thing down here. We can say that the actual amount used now, so this one, it's still 6 times, but now it's 51,000 instead of the 50,000. So now we're at 306,000. And the standard cost is going to be, so to figure out the standard cost, you need the 11,000 units we produced, multiply that by the 5 kilograms per unit and the $6 per kilogram. So we have to multiply by all that, and that turns out to be 330,000. So to find, this is not actual, this is split. I'm sorry. Find the split minus the standard. You still get this negative 24,000 and it's still favorable. This is still unfavorable. And then we can do the same thing down here. So we can find for the labor rate variance, we know that the actual is 800,000 because that's what it told us, right? Actual direct labor rate up here of 800,000. And the split is going to be the standard price, which is 12 times the actual quantity of hours used, which was 65,000. That's going to come out to 780,000. So if you do actual minus split, you still get positive 20,000, which is still unfavorable. And if we want to do it for the efficiency variance, we can still do that. So we want the split cost, and for the labor, the split cost is exactly the same as it is for the direct labor rate variance. For the materials variance, they're probably going to be different, but for the labor, the split cost will be the same. So we just figured out the split cost. We know that that is 780,000. And the standard cost is going to be 12 times 6 times the 11,000 units. So that is going to be 792,000. So if we do, keep it all on one page. If we do the split minus the standard, we're going to get a negative 12,000, which is still favorable. Are there any questions? You definitely don't have to do it both ways. Please don't do it both ways. You can just pick whichever way you like better. But that's how you get through that problem. The other two problems are much shorter. Okay, so now we're going to talk about investment center performance. Thompson Limited has a division that generated $5 million in sales and operating income of $1 million on average, with average operating assets of $2.8 million, and the company's management team expects division managers to generate sufficient income to guarantee a minimum return of 15%. And it wants to know what the division's residual income is. So residual income is a good way to compare companies or segments, divisions, whatever, that it's better for them to be similarly sized. But the residual income is the income left over after the company earns some minimum ROI. So we got the residual income it's the net operating income minus the average operating assets times the minimum required ROR. So that's the equation that we're going to use. So the information that we need to fill in that equation, we need the net operating income, which is $1 million. We need the average operating assets, which is $2.8 million, and we need the minimum required rate of return. So that is 15%. We are just going to type all that in. We have $1 million. We're going to subtract the 2.8 million times the 15%, which comes out to be, so it's 1 million minus, and then this 2.8 times 120, that turns out to be 420,000. So if we do all of this, that is equal to 580,000. So like I said before, it's the income left over after the company earns some minimum return on investment. So after they earn this minimum 420,000, that's the minimum required return on investment, then they have 580,000 left over. That's the residual income, as opposed to the division's return on investment. So ROI is another way to compare, but this is a ratio, so you can actually compare things that aren't quite the same size. But so it looks at the division's operating income as a percentage of the asset base used to generate that income. So ROI equation is return on investment, it's net operating income divided by the average operating assets. And so those numbers are just the million and the 2.8 million. So 1 million divided by the 2.8 million. So then this one is equal to 35.7%. So at this point, what we would do is compare 35.7% to the 15% and say, is it bigger? And it is. 35.7% is much bigger than 15%. So this is, you know, this is good. We compare it to other divisions ROIs. It's just a real simple calculation that people use to make comparisons. Are there any questions about this? Okay. Oops. And net present value. Okay, so Mayberry Textiles Inc. is considering the purchase of a new machine, which has an initial cost of $400,000. Annual operating cash inflows are expected to be $100,000 for each year for 8 years. No salvage value is expected at the end of the asset's life. Mayberry's cost of capital is 14%. So net present value is something that if you take more business classes, you're going to see a lot of. So a good way to do this is to set it up like this. So we have the cash flows, we need the year, we need the amount, we need the present, whoops. We need the present value factor, and then we figure out present value. So in the question, it tells us that we have an initial cost of $400,000. Annual operating cash inflows are expected to be $100,000 each year for 8 years, and the cost of capital is 14%. So let's set this up. So it tells us that there's a initial cost, so that's an initial investment in year 0 right now of 400,000, and this is an outflow, so it's negative, costing us money. Interesting. The present value factor of right now is 1. So the present value of this initial investment of $400,000 is just $400,000. But now it also, I'm sorry?
I just had a quick question. So every time you start at year 0, you just assume that the PV factor is just whole or 1?
Yeah, for right now, for right this instant, my cash is worth what it's worth, right? Like it's not because it's right now, it's just worth what it is right now. But so the
Okay.
present value factor is telling you what it's going to be worth later.
Okay, and then the parentheses just mean a negative number, right?
Yeah, that's how accountants do that. So I'm just
Yeah,
kind of
just
used to
double
doing it
checking.
that way. Okay, so then now we're going to look at the annual inflows. So those are for years 1 through 8. Now you have to pay attention when you do these. Hopefully they won't make it too complicated, but if it's the same every year, then you can do the annuity thing. But if it's not the same every year, then you have to use the present value tables of like a lump sum to figure things out differently. So as long as it's the same every year, you can just do one thing and call it a day. And so it is in this scenario. So it's 100,000 every year for 8 years. And now we need the present value factor. So when you go to figure out the present value factor, there's going to be tables. Have your professors given you the tables?
Yes.
Okay, so yeah, just use your tables. So because this is an annual inflow every single year for 8 years, what you're going to look for is the present value of an ordinary annuity for 8 years at 14%. So you'll have to, I'm sorry?
What if you're like, my professor didn't give us the table, I don't think. So, and also, like in the textbook, it has the present value tables, but there's so many. How do you tell which one is which?
I believe
Okay.
it's Appendix A, according to my teacher in the textbook.
So
Yeah, they're
right,
there,
yeah,
but
so
there's a bunch of them.
there are. I think there's probably 5, right? There's the present value of $1, the future value of $1, there's at least 4. The present value of $1, the future value of $1, the present value of an ordinary annuity, and then there's also an annuity due. So if you're looking for, if you have a number, if it's like worth like, $500,000 10 years from now or whatever, well, then you need to find the present value. What is that worth now? But if you have $400,000 today, what's that going to be worth 10 years from now? Well, now you're looking at the future value. If it's a lump sum, like if it's just, we have to pay this $400,000 right now and we don't have to pay it ever again. We're just paying it right now. That's a lump sum. But with these $100 inflows, well, now we are expecting that every single year. So now we're talking about an annuity, annuity annual. And so an annuity is either ordinary, meaning that the money comes up at the end of the period, at the end of the year, or it's an annuity due, meaning that you pay it right now. Like rent is typically like you pay January's rent on January 1st. So that's typically like an annuity due sort of situation. So this, because it doesn't tell us that it's due right now, it's just saying we're expecting it to be $100,000 each year. If they don't specify, you can just always assume it's an ordinary annuity. And since we're still just doing kind of basic stuff, it's not splitting it up semi-annual or anything like that. So it's just going to be 8 years and 14%. So you'll have to find the present value of an ordinary annuity of $100,000, and you're going to look across the top is where the percentages are, and so you're going to look for 14%, and then down the side you're going to look for the 8, and you're going to find whatever that number is. So your teachers will give you a present value table. I do have a copy of it. If you want me to email it to you, I can. I just need your email address. If you want to just email me, say, hey, can you send it to me? I will absolutely do that for you, not a problem. For our purposes right now, I've already looked it up, so I'm just going to tell you what it is. It's 4.6389. So once you have that present value factor, you just multiply it by that payment amount, that $100,000, and you're going to get $463,000. 46,890.
So to get the present value factor, do you add up all the numbers from 1 to 8?
So you can do that. You can, it'll get you to the exact same place. So if you had the present value tables, let me see. Do you want me to go see if I can, it's in my email. Hold on. Dr. Burt just sent it to me this morning. It should be here somewhere. Here it is. Oh, this is a very stripped down version, but where are we here?
Also, sorry, in the book it only goes up to 12%. So like we would just hope that they wouldn't give us a percent that's higher than 12.
Yeah, just hope that they're not gonna give you something that you can't figure out. Okay, so can you see this? This is the table that he sent me this morning. I think this is the one that you should be using on the test. So for this one, whoops, didn't mean to do that. Share screen, present value, share. Okay, sorry. Okay, so for this one, we, use the highlighter. Okay, so we would take the ordinary annuity table because it's the every year thing, right? So it was 14%. So we would look across the top, get to the 14, and then it was 8 years. So if we follow this all the way over, it's this 4.639. You see, so that's
Okay,
there.
thank you.
But if we were to, if they were different amounts, for example, they weren't just one, if it was like 100,000 for years 2 and 3, and then 50,000 in year 4, and then 200,000 in year 5, if they're giving you numbers all over the place, you can use the present value of an annuity, or not of an annuity, present value of $1. And if you were to add all of these things up, point all of these things here up, you would get to 4.639.
Okay.
So that's kind of how that works. Let's go back to where we were. Stop this share, and then let's go back to this one. Okay, so now that we have figured out what this number here is, if we just do the math, so negative 400,000 plus 463,889, we would get that this is 63,890, and that's our net present value. So Part B asks, based on your analysis in Part A, should Mayberry purchase the new machine? Anytime your net present value is greater than or equal to 0, anytime it's positive or 0, that means that the project's rate of return is greater than or equal to the minimum desired rate and should be accepted. So we want 14%, and so this is telling us that this, the fact that this is positive is telling us that the rate of return is bigger than 14%. It's not telling us what it is, it's just telling us that it's better than 14%. So because it's positive, we are definitely going to accept it. If it was negative, that would tell us that the rate of return was less than desired. And so we would say no, because it's not going to return as much as we want it to. So positive is greater than desired. So are there any questions, other questions about this? Good. All right, so that is the end of part 2. Do you have any, I can go through the multiple choice questions if you want. I could just, if you don't want to sit here any longer, I could post a video that you could watch later if you want to do that. I don't know. What are your thoughts on multiple choice questions right now?
I feel like I struggle more with those than the part twos.
All right, well, let's go through them then. All right, so which of the following are advantages of budgeting? So A says it helps management to get out of just doing things the same way and notice what can be improved. So that's true. Budgeting can definitely do that. It can be used for performance evaluation. It can definitely be used for performance evaluation. That's what all that variance stuff helps us do, in addition to all the other things, but the variance stuff can help us with performance evaluation as well. And then it unifies the efforts of various departments in pursuit of the company's objectives. Also true. So the answer to number 1 is D. Number 2, what is the original starting point that determines the levels of all budgets? So maybe you remember, so the way that we start with budgeting, we start with the sales budget, and then we move to the production budget. And then after that, we can do the direct materials and the direct labor and the manufacturing overhead. And then we can move on to the cash budget. Remember, there's like 9 budgets. So from cash, we can move on. But all of it has to start with the sales budget. And so the sales budget is, we have to start with the forecasted sales levels. So the answer to this one is A. Number 3, Byron Products has a favorable materials price variance. Which of the following would be the least likely reason? So we're looking for the least likely reason for a favorable materials price variance. So we remember that the materials price variance, we're going to take the quantity and hold it constant, and we're going to compare just the prices, the actual price minus the standard price. And in order for it to be favorable, the actual price has to be less than the standard price, right? So we have to spend less than we were supposed to. So the company over budgeted the standard price for materials. That could definitely help the standard price be greater than the actual price. The company unexpectedly was able to take advantage of quantity discounts offered by its suppliers. That would also help our actual price be less than our standard price. The company's employees were more efficient with the use of their production time. Well, so that doesn't really have anything to do with price, does it? That's more of a direct labor efficiency thing. And then the company purchased a substandard material at cheaper prices. That would also give us an actual price that's less than our standard price. So the answer to this one is C. Number 4 says, Dabney Inc. has a favorable direct labor efficiency variance. Which of the following would be the most likely reason for this variance? So a direct labor efficiency variance, we're going to take our standard price, hold that constant, and we're going to compare our actual quantity to our standard quantity. We want our actual quantity, because we're looking for favorable, our actual quantity to be less than our standard quantity. So the company used lower paid workers in the production process more than they had expected. Well, that's not really a direct labor efficiency variance. That's that they paid them. So this is a price variance, the rate variance. Employees took shorter amount of time to produce the product than expected. Well, so that is going to give you the actual quantity of hours used less than the standard quantity. That's what we're looking for there. The company used a standard direct labor rate that is too low. That's, again, that's the rate variance, a price variance. And the employees used less direct materials in the production process than expected. So less direct materials. Well, now we're talking about a materials efficiency variance. So the answer to this one is B. Number 5. The difference between the split cost and the actual cost for direct materials is called what? Okay, so do you remember we were just talking about this? We had the actual cost we had the split cost, and we had the standard cost. And we said that the difference between the actual and the split cost was a price variance. And the difference between the split cost and the standard cost was the efficiency variance. So it's saying, what's the difference between the split cost and the actual cost for direct materials? That is this one here. That is the materials price variance. The sum of the direct labor rate and efficiency variances is equal to, okay, so this is saying this here, this price variance and this efficiency variance, if we add them up, what's that equal to? So that's like saying this difference here, the difference between the actual and the standard. And that, my friends, is the flexible budget variance. So that is letter C. This works with the labor rate and efficiency variances. It does not work that well necessarily with the direct materials price and efficiency variances. We talked about how a lot of times the amount of materials that they purchase is not the same as the amount of purchases that they, or amount of materials that they use. And so those two numbers might not necessarily add up correctly, but for the labor rate and efficiency variances, this works. Number 7, the amount of direct materials purchased, oh, we just talked about this. The amount of direct materials purchased is usually equal to the amount of direct materials used in production that period. We just talked about how this is generally not going to be true. This is false. What we buy and what we use aren't necessarily going to be the same. A direct materials price variance is unfavorable if the price paid per unit is greater than the standard price per unit. So unfavorable if the amount that we actually paid is greater than the amount that we should have paid. Yes, that's true. We paid more than we were supposed to, and that's unfavorable. True. A negative direct labor efficiency variance is considered favorable. So the direct labor efficiency variance, we have, if we recall, it's the standard price. We hold that constant, and then we can compare the actual quantity to the standard quantity. And if this number here is negative, that means that the actual quantity that we used is less than the standard quantity. And it's good, right? That's what we're supposed to do. So that's favorable, and that's what we're looking for. So the answer here is true. Which of the following managers would be most concerned about a segment's ROI? So ROI is return on investment. So a cost center manager is concerned with costs. And a profit center manager is concerned with profits. And an investment center manager is concerned with investments. He is absolutely concerned with the return on investment. So number 10 is C. Strategic planning is essentially a form of short-range decision-making regarding day-to-day operations. So strategic planning is usually done by the higher-ups, and higher-ups are generally more long-term thinkers. They're concerned with not the day-to-day stuff, but with where the company is going long-term. So strategic planning is generally not going to be short-range. Short-range stuff is done by lower managers, and that's going to be more like, I don't know, operational, like annual operational planning or something like that. So this one here is false. On the budgeted statement of cash flows, cash receipts from customers are generally equal to the budgeted level of sales. So the budgeted level of sales would be great, but the budgeted statement of cash flows, there's a lot of reasons why those two things might not necessarily be the same, but one of the big ones is that not everybody pays in cash, right? So this is going to be false. Which of the following statements regarding the structure decentralized organizations is false? So decentralized organizations, they, the authority in those organizations is all spread out, right? It's decentralized. So managers may become so concerned with their own area of responsibility that they lose sight of the company's overall focus. That can definitely happen. And there may be a lack of coordination and communication between segments because authority is all spread out. That's also true. Sharing of unique and innovative ideas developed within a segment may not occur. That's also true. So all these things, these last two things, they refer to silos. Departments just kind of like keeping to themselves and not sharing things around. Decision-making authority rests solely with the top-level management. Well, that's false. Decision-making authority gets spread out. It's not just top-level management that gets to make decisions. So 13D is false. Which of the following areas is not a category on the balanced scorecard? So the balanced scorecard is Flick. F stands for financial performance. L stands for learning and growth. I stands for internal business processes, not internal strategy development, internal business processes. Pen's terrible today. And then C stands for customer satisfaction. So the answer to D, to 14 is D. 15, the time value of money dictates that money received today will be worth what in the future than it is worth today. So the time value of money dictates that money received today will be worth more in the future than it is worth today. So $1 today is worth more than $1 tomorrow, but $1 received today is worth more tomorrow than it was today, presumably because you did something smart like invested it or something. But the answer to that one is more. Cash payback period. Okay, so the cash payback period takes the original investment and it divides it by the cash flows, the net annual cash flows, and that gives you the number of years it's going to take to pay that back. So the payback times the cash flows is equal to the original investment. So the number of years needed on an investment for the after-tax cash flows to equal the original investments is C. The number of years of positive after-tax cash flows needed to make the net present value. Now, the payback period, the way that we talk about it, doesn't have anything to do with the present value. The hurdle rate is the minimum rate of return that a company expects to receive from any investment that they undertake. That's true. It's just a definition. A budget used to plan for the acquisition of long-term assets is called, so if you're considering long-term assets or long-term investments, investments in productive assets, like long-term assets, that is a capital budget. I'm not going to go through the definition of what all those other budgets are, but this one is a capital budget. Long-term investments in productive assets. Which of the following is an advantage of decentralization? So we just talked a little bit about decentralization. We're looking for an advantage. It allows top-level management who normally work at corporate headquarters to get involved with the day-to-day decisions that need to be made at lower levels. No, that's not what's happening here. It allows managers to focus on their own area of responsibility rather than what is best for the company as a whole. Well, that doesn't really sound like an advantage, right? You would want them to consider what's best for the company as a whole, even if they are just considering their own area of responsibility. It allows decisions to be made in a more timely manner. Well, that is a good thing. And it requires very little as far as manager training costs. I would argue that that's probably not true. So the answer to number 19 is C. All right, here's a little bit of math. Pennington Products has 2 product lines, R100 and R200. Revenue and cost information for each of the product lines are as follows. And then it gives us a bunch of information. Refer to the Pennington Products information above. What is the segment margin of the R100 product line? So the segment margin is the net profit or loss from that segment. So if we come up here to R100, this is the one we're looking at, we can find the contribution margin, which is the selling price minus the variable costs, and that'll give us 30. So we know that we sold 30,000 units. So 30 times 30,000 units, because the contribution margin tells us what contributes to our net income. So this is 900,000, but we are looking for a net profit or loss. So we still do need to consider these fixed expenses, right? So if we take out the 250 that they're telling us for the fixed expenses, now we get 650 for our net profit or loss. So our segment margin is A, 650. So refer to the Pennington Products information above again. If the total fixed expense of the company is 850, what is the common fixed expense? So fixed expenses come in 2 flavors, right? They come in traceable fixed costs, which is what they're listing up here. Traceable fixed costs benefit just the one segment, but common fixed costs benefit multiple segments. They are things like if all the departments are in one building, it would be like the property taxes on that building, that sort of thing. So we know that the traceable fixed expenses are up here. So if we add those together, the 250 and the 360, we get 610. And we know that the total fixed costs are 850. So if we subtract out the 610, we get 240. That 240,000 is what is common to all the segments, not just the R100 or the R200. So the answer to 21 is D. Which type of manager would be allowed to decide whether or not new manufacturing equipment should be purchased? So new manufacturing equipment to be purchased, that is an investment in a long-term asset. So an investment is the concern of an investment center manager. And finally, Findlay Company has its company headquarters based in Raleigh, North Carolina, and has 6 individual retail stores spread throughout North Carolina and Virginia. Which of the following costs would most likely be treated as a common cost for segmented reporting purposes? So we just talked about these. So the property tax cost for the Virginia stores, well, that just benefits Virginia, right? Doesn't help North Carolina at all. And the direct labor cost for North Carolina, well, that just benefits North Carolina. That doesn't really benefit Virginia at all. But the lease cost for the company headquarters, well, that's helpful for everybody, right? Everybody needs the company to have a headquarters. And utility costs for both the Virginia and North Carolina stores, okay, so that technically kind of benefits both, but you could definitely also separate that out to Virginia and North Carolina. So the answer to 23 is C. I think that's all the multiple choice. Yes. So how are we feeling? Do you have any more questions? Are there any questions about anything I went over? Good. All right.
Do you know if this will be available to Dr. Hahn's classes? Like if she'll be able to post it?
The test?
No, like what you just did in case I want to review it one more time.
Oh, I'll post the video. I have I've been putting them on, because I can't like put them on your teacher's websites or whatever. I've been putting them on YouTube.
Okay.
So I will, once it's all like processed and up and running, I will post it so you'll be able to go back and watch it.
Okay, what should we like type in?
Oh, I'll send the link out. The same sort of email that you got, when I told you about this, I'll just send the link out.
Okay, thanks.
Yep. All right. So you guys good then?
Yep.
All right. Well, thanks for coming today.
Thank you.
All right. Have fun studying.